everyone, Paul Lesell, the virtual investor here. And today I'm going to talk about what's going on in the real estate market here and how it's going to affect investors through the rest of 2022 and into 2023. All right, before I dive in, I'll make sure you click on the subscribe button, hit the like button, and hit the bell notification so you get notified when we put up a new video. All right, let's dive into the data here. So looking at what's going on from the beginning of this year, 2021, till now, obviously rates have doubled, and no calendar year in the history of this country have rates doubled. So this has really put the skids on home buying, right? A lot of people are pulling back here. So let's look at the data. So they've reached their highest rates, mortgage rates have reached their highest levels in 13 years, which is pretty telling. It's pretty substantial there. And in large part because of the war in Ukraine and also inflation that we're seeing here and people's appetite for the 10-year T-bond. So mortgage rates are currently about 5.81% as of June 23rd. And it's being recorded here on the 27th of June. So I don't have updated data to give you on that yet, but I think things have stayed fairly flat since that point. And also Google searches, right? People going online and searching Google for homes for sale is down 14% from a year ago. Pretty substantial drop, and I expect that to continue even further because this is the hottest point of the year for home buying. I expect that to drop as we get later into the summer and into the fall. Touring activity is also down 6% from the beginning of the year and also 24% from last year at this point, which is really substantial. But last year was the hot year to move. Rates were incredible. It's the time I moved last summer here, and a lot of other people as well. People are still migrating. People are still moving though. So there is still demand. I know inventory is starting to increase, but it's still historically very low. We don't have that 6-month supply yet of inventory. And as long as rates remain somewhat stabilized here and don't go up dramatically more than this 6%, 6.25%, 6.5%, 7%, I'm not going to hit the alarm bell yet. But let's put it this way. It's on my radar. I'm paying attention to what's going on here. And I'm hoping for the best, but also planning for rates to go up. So just things to do that you can do to reduce your risk. Obviously, what we do when we're looking at properties is you're trying to get the after repair value, the ARV, take it by, multiply it by 70 or 75%, depending on what market you're in. Some of them you've had to do 80%. These markets are real hot, like in Southern California, like in Arizona, and Florida, and in Las Vegas. Change that, drop that down. So if you were doing 80%, drop it down to 70 to be safe. Prepare for a 10% correction in the market, especially the cyclical markets. Cyclical markets are markets like Florida, Las Vegas, Arizona, Southern California, and start really focusing maybe more on purchasing if you're buying virtually in more linear markets like the Carolinas, like Indiana, like Ohio, like Missouri, Kansas, and markets like that. So you want to avoid the cyclical ones as much as you can, or reduce your risk in those markets, not necessarily avoid, and focus a little bit more on those linear ones that aren't affected as much during a downturn. And let's face it, we're heading our way to a downturn. We've peaked in the real estate market. We're probably plateauing now. We're getting ready to start our decline. We're going to see where we go here. The data is going to tell us, but remember, real estate is a lagging indicator. So what's going on with the interest rates is driving down demand, but we won't see it for another 3 months probably or so with numbers, actual numbers that come up. So focus on those markets, get away from the cyclical as much as you possibly can. Now, if you are entrenched in those cyclical markets, like I said, just drop your numbers, increase your repair numbers, try to increase your spreads a little bit. Again, I know there's still a ton of competition in these markets, but this is something that really is important if you want to continue to grow your business and make sure you're not out of business at this point next year or the year after. All right, guys, hopefully this was helpful, and we'll catch you in the next video.